Thank you for joining me. I'm Alex, and today we're talking about Wendy's because Wendy's just announced that they're going to do breakfast, which somehow dropped the stock about 10%. So what Wendy's does is Twitter insults mostly, and also they sell food. Wendy's is a fairly cheap restaurant competing with McDonald's, Burger King, and the like. So their price currently is $19.71, as I said, down over 10% today, on a day where the market was pretty much even, so that's quite an accomplishment in itself. PE is slightly under 10. For comparison, McDonald's is 27. So their dividend yield is 1.85% with a payout ratio of only 19%. Payout ratio definitely respectable. I don't think the dividend yield is great. I would like to see that go higher to buy the stock because I don't think that safety of principle is really given because of so much competition in the space, and I think that they pretty much only compete in price and, again, Twitter insults. So their revenue, $1.2 billion, slightly up, but it's only slightly up from the previous year. It's significantly down from the years before that. Earnings of $460 million, which is up huge, but again, not from the previous years, just from last year. Still, that does mean that they're doing something right and moving into the right direction. Total assets $4.3 billion, total liabilities $3.6 billion, and net tangible assets $1.4 billion in the negative, which is also down, which means that they went from 1.3 billion to 1.4 billion in the negative. So balance sheet obviously doesn't look great. The revenue growth does not look great. The earnings growth does look great, but again with a caveat that it's just a short-term spike rather than gradual growth. So to sum it all up, I think the dividend yield is fairly low for a dividend investor, especially given that the balance sheet is terrible. The growth is terrible for a growth investor, and I think a value investor might have a good time looking into the stock because the dividend is not terrible, it's just not great. The balance sheet is bad, but not absolutely terrible. And the PE is pretty nice. So we're getting a huge discount today, minus 10%. I would probably wait a few days at the very least to see where it settles at before trying to trade or buy the stock. So for now, I don't think I could recommend anyone buy the stock. But if you're a value investor, I think the revenue is moving in the right direction. I think the earnings are moving into the right direction. And I think that we could look into the stock more to figure out if that is going to continue in future years or not. And based on that, I think that for a value investor, I don't think it's a terrible stock, especially with the extremely low payout ratio. So with all that said, if you're a value investor, if you want to do more research into the stock, I don't think it's a terrible buy, especially if you were to diversify from like largely tech stocks. I think that they're going to be around for a while, so I think that for the foreseeable future, it's a fairly safe stock. And again, the PE of under 10 makes it fairly attractive stock right now. That coupled with a payout ratio of only 19%. So that's it for me for today. If you haven't already and you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.